Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is November 6th, 2025, and we are taking an in-depth look at the QQQ, the ETF that tracks the Nasdaq 100. First, let's cover the news and recent events that are shaping the market sentiment. There's a bit of a mixed signal in the air right now. On one hand, sources like Nasdaq.com are pointing to a positive broader trend, with more companies returning to earnings growth, which is fundamentally bullish for the economy. However, the short-term picture has been dominated by tech-specific turbulence. Just a couple of days ago, the market opened sharply lower, with the Nasdaq down nearly 2%, largely due to disappointing earnings from AI darling Palantir. This created a ripple effect, hitting other major tech names and sparking concerns about high valuations in the AI sector. This sentiment carried over into yesterday's session, November 4th, which saw a broader tech-led sell-off, causing the Nasdaq to drop and market volatility to increase. So, we have a classic conflict, a potentially strong underlying economy versus sector-specific weakness and valuation concerns in tech, which is the driving force of the QQQ. Now, let's see how this narrative plays out on the charts. Starting with the daily chart, we can see the bigger picture. QQQ has been in a powerful uptrend for most of 2025, setting a series of higher highs and higher lows. The price action culminated in an all-time high just last week, on October 29th, right around the $637 mark. However, following that peak, we see a sharp reversal. This is where the news we just discussed comes into play. The drop began right around October 30th and accelerated this week, perfectly coinciding with the disappointing tech earnings and the subsequent sell-off. Notice the significant increase in volume on these red days, specifically October 31st and November 4th, which confirms strong institutional selling pressure during this downturn. This suggests conviction behind the recent move lower. Now, let's identify our key levels on this daily time frame. The most critical resistance is, of course, the recent all-time high around $637. Any attempt to move higher will face significant selling pressure there. Before that, the $628 level, a peak from late October, acts as minor resistance. On the support side, the immediate level to watch is the low from yesterday's sell-off, at approximately $618. A break below this level would be a bearish signal in the short term. Beneath that, we have a very significant psychological and technical support zone around the $600 mark, which was tested and held during the dip in mid-October. If $600 fails to hold, the next major support area is down near $590, the low from early October. Let's zoom into the last month of price action on this daily chart to get a clearer view of the reversal. Here you can see the strong bullish momentum through October, followed by that clear rejection at the highs. The candle on October 10th showed a massive sell-off with huge volume, which was an early warning sign, even though the market recovered to make a new high. The recent drop from $637 to $618 was swift and decisive. However, yesterday, November 5th, we saw a bounce. The price closed higher on the day, forming a green candle after a significant sell-off. The critical question now is whether this is simply a dead cat bounce before the next leg down, or the beginning of a recovery and a successful test of support. To get more clarity on the short-term battle, let's switch to the 1-hour chart. Here, we can see the structure of the recent sell-off in more detail. The decline was aggressive, but we can see the price is now trying to form a base above that $618 low. The price has been making a series of higher lows on this hourly time frame since yesterday's bottom. This is a constructive short-term sign for the bulls. Immediate resistance on this time frame appears to be in the $625 to $626 zone, where the price consolidated before the final drop on November 4th. A convincing break above this level could give bulls more confidence. Conversely, if the price rolls over and breaks the $618 support, the bearish momentum would likely resume. For the day traders, let's quickly look at the 15-minute chart for the most recent action. On this time frame, we can see a clear bottoming pattern forming after hitting the low near $618 yesterday. Throughout the rest of that session and into yesterday's session on November 5th, the price has been grinding its way higher in a choppy but upward trending channel. This indicates that in the very short term, buyers have stepped in to defend the lower prices. The price is now consolidating near the highs of yesterday's session. The key will be whether it can maintain this upward momentum or if it will falter as it approaches that tougher resistance zone we saw on the hourly chart. So, let's go back to the daily chart to recap and formulate a plan. The long-term trend is still up, but the short-term trend has shifted down, creating a lot of uncertainty. The battle lines are clearly drawn. Let's quickly summarize the key price levels to watch. Major resistance is at the all-time high of $637, with minor resistance at $628. Critical short-term support is at $618. Major support levels below that are $600 and then $590. Now for some potential scenarios. In a bullish case, if buyers can push the price decisively back above the $628 resistance level, it would suggest the pullback is over. This could open the door for a retest of the $637 all-time high. I'd place the likelihood of this at about 50%, and this would be reinforced by positive market news or strong earnings from another major tech player. In a bearish scenario, a failure to hold the $618 support level would be very significant. A break below that would likely signal a deeper correction, with the first target being the major psychological support at $600. I see this as having a 35% probability, which would increase if we see more negative tech news or hawkish inflation data. Finally, there's a 15% chance we see a neutral, sideways consolidation. The price could remain range-bound between $618 and $628 for several days as the market finds its footing. Keep an eye on upcoming economic data and headlines from the major tech companies, as these will likely be the catalysts for the next major move. That's our analysis for today. Please remember, this is not financial advice and is for educational purposes only. Always do your own research and make investment decisions based on your own risk tolerance. Thanks for watching Explain the Charts, and we'll see you in the next video.